Imagine a brilliant engineer tasked with building a bridge across a deep, unforgiving chasm. He calculates the exact weight of the vehicles that will cross it. He estimates the precise wind resistance, the exact tensile strength of the materials, and the microscopic shifts in the earth. His mathematical models are a masterpiece of modern efficiency. He builds a bridge that can hold exactly 10,000 pounds, not a single pound more. In the modern financial world, this is exactly how the vast majority of analysts and fund managers invest. They build highly complex, fragile, discounted cash flow models. They try to predict a company's exact earnings 10 years into the future, down to the last decimal point. They buy a stock, believing their predictions are perfectly accurate, and they demand absolute control in a world that is fundamentally uncontrollable. But the world is not a sterile spreadsheet. The world is a place of profound, unrelenting chaos. One day, a storm arrives that was not programmed into the engineer's flawless model. Inflation suddenly spikes. A global supply chain breaks down. A new competitor disrupts the industry overnight. Or simply, a truck weighing 10,001 pounds attempts to cross. The model fails. The bridge shatters, and your hard-earned capital is wiped out. You cannot predict every macroeconomic shift. You cannot foresee global pandemics, sudden changes in consumer habits, or the irrational panic of the masses. If your investment strategy requires a perfectly accurate view of the future to be successful, you are standing on a fragile bridge. You have zero room for error. The father of value investing, Benjamin Graham, witnessed the absolute devastation of the Great Depression. He learned the hardest way possible that survival in the stock market does not come from perfect predictions. It comes from structural protection. Graham's solution was brilliantly simple. When he built a bridge for a 10,000 pound truck, he didn't build it to hold 10,000 pounds. He built a massive, over-engineered stone structure capable of holding 30,000 pounds. He called this massive structural buffer the margin of safety. In investing, this means if you calculate the true, conservative, intrinsic value of a business to be $100 a share, you do not buy it for $98. You patiently wait until the market panics and offers it to you for $60. You don't need to know the exact weight of the truck if the bridge is virtually indestructible. Warren Buffett, Graham's greatest student, took this defensive philosophy and elevated it. Buffett realized that a true margin of safety is not just about buying a mediocre business at a mathematically cheap price. True safety comes from the quality of the fortress itself. To build generational wealth, you must demand an economic moat, a deep structural advantage that protects the business from competitors. You must enforce uncompromising criteria. Has this company operated successfully for many decades? Does it consistently generate rising profits and a true positive cash flow, rather than just accounting tricks? And crucially, does it pay reliable dividends, rewarding its owners even during severe economic downturns? When you buy a world-class cash-flowing fortress at a massive discount to its intrinsic value, time stops being your enemy and becomes your greatest ally. The absolute beauty of the margin of safety is that it completely frees you from the burden of perfection. The legendary economist John Maynard Keynes once said, "It is better to be roughly right than precisely wrong." If you demand a massive discount on a high-quality business, your analysis no longer needs to be flawless. You do not need a perfect spreadsheet. If the gap between the price and the true value is large enough, you don't even need a calculator. You just need common sense. You have built a psychological and financial buffer for your own mistakes, for bad luck, and for the inherent unpredictability of the world. But to execute this highly rational strategy, you must master the hardest discipline of all, your own mind. The stock market is heavily driven by a manic depressive entity that Benjamin Graham called Mr. Market. Mr. Market will tempt you daily to cross fragile bridges. He will offer you exciting, unproven stories. He will try to infect you with the fear of missing out when speculative assets skyrocket. You must completely detach from this noise. You must retreat into your inner citadel. You must develop the stoic patience to sit in cash for months or even years, doing absolutely nothing, waiting for Mr. Market to fall into a state of deep depression and offer you a supreme business at an undeniable discount. In investing, frequent activity does not equal achievement. Extreme patience does. The storm will inevitably come again. The market will crash. Unprecedented panics will ensue. But the disciplined value investor feels no fear. He sleeps soundly. He knows his bridge was built to hold £30,000. He rests securely in the deep knowledge that his dividends will continue to flow and his capital is heavily shielded by a formidable moat. Stop searching for the perfect prediction. Embrace the chaos. Demand a margin of safety. Master your mind. Master the market.